Shri Gurubhyo Namaha. Om Shri Ganeshaya Namaha. This is part 1 of presentation by myself, Brahmadesh Narsimhayer Venkatraman, on InflaPro and systematic withdrawal plan. I am Brahmadesh Narsimhayer Venkatraman, presently residing at Pune. This video is part 1 of information about inflation protected systematic withdrawal plan on mutual fund, fixed deposit and other types of investment. This video will be useful to some startup or entrepreneur of banking, NBFC, MF, insurance companies looking for innovative methods of giving inflation protection to customers without any extra interest burden for the company. For others like investors, chartered accountants and students, in particular common students, it will be just an information that an alternative method is available to the existing conventional flat rate of return. It is an invention named as InflaPro, created as early as 2010 by myself. Let me explain the conventional and InflaPro concept from the outcome of an easy example with the help of Google Sheet to show that both have exactly identical interest burden. One can use Excel or LibreOffice or any other spreadsheet also. Consider a scheme of investment of rupees 1 lakh giving a return of 10,000 rupees per year for 12 years. At the end of 12th year, principal is returned. Now calculate return percentage in the Excel with the available function IRR within bracket data range. IRR is nothing but internal rate of return. In the case of conventional flat rate of return, year after year, for a principal of 1 lakh rupees, 10% per annum return, the first year dividend return is rupees 10,000. Second year return is also 10,000 rupees. Third year is also 10,000 rupees and so on. And 12th year return is also same 10,000 rupees. The maturity of or surrender value at the end of 12th year is the return of the principal rupees 1 lakh. The total disbursement is 2,20,000 rupees. Conventional equal amount of systematic withdrawal plan at 10% per annum and at the end of 12th year getting the return of purchase price. In a spreadsheet, let column A be filled with year 0 and 1 to 12. In column B, it is filled with the investment amount of 1 lakh at year 0 and systematic withdrawal of rupees 10,000 in year 1 and copy the corresponding cell into cells for the year 2 to 12 in the same column below the cell B1. In next column at year 12, say column C13, enter credit of maturity amount, and in the next column D, add cells to these two columns B and C. In a separate cell, say E5, enter equal to function and IRR within bracket data range, that is D1 to D13 as shown above. The IRR is nothing but internal rate of return, which is 10%. Consider the following outcome of InflaPro calculation for the equivalent return with inflation protection of 6%. For calculation, please visit my website provided under the description and fill in suitable values in the menu provided and see the result. Now take it granted that the starting return in the first year is rupees 7,594.99, say rupees 7,600 approximately. In a same spreadsheet on similar lines, prepare the first year return in suitable column, cell say F2, and then fill in subsequent cell below that cell. Increase the return amount at the rate of 6%, such as 8,050.69, and continue up to cell below the cell corresponding to 12th year, that is cell F3 to F13. Also fill up 12th year return of principal in adjacent column, say G13. The formula in cell F3 will look like round off bracket F2 multiplied by bracket of 1 plus 6 by 100 bracket close, comma 2 the number of decimal places bracket closes. 6 is nothing but the inflation protection rate. Just like previous case, work out the total figure in column F plus G in column H, and then work out the function IRR data range H1 to H13 in a convenient next column I. You will find that the internal rate of return is same as 10% in both the cases. In this InflaPro case also, the internal rate of return works out to be same as 10%, which means that there is no extra interest burden to the financing company. The cumulative return in previous conventional one was rupees 10,000 into 1,020 rupees, apart from return of principal. In the InflaPro case, the cumulative total is rupees 1,28,000 and odd, apart from the return of principal. One gets approximately 7.6% to 14.42% return on the principal year over year, instead of conventional rate at flat of 10% every year. Yield is another parameter in financial management, and in case of InflaPro, yield is more than the conventional flat rate of return. My friends raise a question that in order to provide inflation protection, what change a finance company has to do with market options? Finance company invests its fund into market options like 75% in equity market, 20% debt market, remaining 5% in government securities. I do not propose any change or suggestion in this regard. Whatever market option they are doing for paying conventional dividend payments, the same they can continue. I am giving only an alternative method of inflation protected return without any extra burden of interest. Minor clarification. Let the conventional flat rate of return percentage be 10%. InflaPro does not protect this rate of 10% to mean to say not like 10%, 10.6%, 11.3% and so on. Return in a typical case, the percentage on face value is less than this conventional rate of 10% for the first half of the term. Say, first year 7.5%, second year 8.05% and so on, sixth year 10.16% and then and so on, and by 12th year 14.42% with 12 years perspective. Therefore, overall disbursement of 2,28,000 and odd is more than conventional one with the same internal rate of return. Let us see more in next part of this continuation about the outcome of InflaPro with respect to mutual fund or any other investment with systematic withdrawal, monthly plan at 7.5% per annum, and also growth of net asset value NAV to 240% in 10 years, that is 2.4 times, and also the benefit of InflaPro. Until then, one may visit my site beanvenkat.com and explore. Thanking you one and all, and request you to view my next video as and when published. Continuing the session for those who want to know about Excel calculation of IRR function. Those who are already familiar with such preparation can cut short the session and come to view my next video as and when published. There is no need to master these Excel concepts in calculation of IRR, as my web pages are comprehensive and to calculate the return either forward with IRR, the interest parameter given node, or reverse where interest is to be calculated from known disbursement values. Let me go to Excel sheet. That is, in my case, I am taking the Excel sheet, the Google sheet, and this Google sheet already has been filled with formatting. This format is in Indian currencies, and negative numbers are shown as credits. Let me delete all this filled data and start fresh. Let us say in A column, you start entering the year 0 at A1, and down below you start entering the year 1, 2, etc. Now we can copy this to up to 12 years. At B column, start entering the principal. At cell B1, it is 1 lakh rupees as the principal. Now return in the first year is minus 10,000, minus 10 for credit. Now copy this cell B2 into the cells down below. In cell C12, that C13, that is the corresponding to year 12, enter the return of principal as equal to minus the principal figure at column B1. In cell D1, start entering the sum of the column B as well as column C, that is B1 plus C1. Now copy this D1 cell into the cells below up to year 12 in C13. And now work out the IRR in any random cell in the column E as equal to IRR within bracket the data range from D1 to D13. Now we got the figure as the internal rate of return is 10%. Now we can similarly fill up for the InflaPro. Let us copy this, leaving the IRR. Let us copy this figure into cell F onwards. A principal is 1 lakh rupees in F1, and now the first year return, interest return is 7,594.99. It is entered as a minus figure so that we can get it as a credit. The next cell down below, that is F3, enter the formula equal to round off 1 plus round off the previous year value, that is F2 multiplied by 1 plus 6 divided by 100. 6 is the rate of inflation comma, decimal place 2. Now copy this cell value into the cells down below from up to F13. Now the sum is also worked out. Now we will go to the column F, column I, and cell I5 or any random cell in column I, any random cell on column I. Enter the value as equal to IRR within bracket. The selected range is H1 to H13. Now we find that the figure 10% IRR is identical in both the cases, whether it is in the flat rate return value of 10,000 rupees each or with inflation protected rate from 7.56% to 14.42%. This verifies my claim that there is no change in internal rate of return. Now let me close this. Thank you.